Hey, it's Rav. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. This show is designed to help us make money with our money. You see, often we take our precious time, we go to work in order to make money so that we can eat. We take our time, we go to work, we get a paycheck so we could provide. But imagine a world where money makes you money so that you could work a little less if you wanted to. You had more time to enjoy the things that mattered most. You could spend time with family, friends, engage in a purpose greater than yourself. Remember, whenever you're offered any type of investment opportunity, you always want to ask 4 questions. 1, what is the return on investment? 2, when do I get that return along with the money that I put in? 3, what is the investment amount needed? And 4, what is the worst case scenario? Super excited about today's show. We're going to be talking to my good friend. Wait for it. We'll be right back. Coming up, we talk to our mortgage specialist, Kyle Ford, on how we can borrow money and then make money.
It's all about your comfort level and being able to sleep at night. But this is a type of strategy that I'm finding so many Canadians are really finally being able to envision their retirement income by using this strategy.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
Hey, it's Rav. Welcome back to Everyday Investor. Today we're going to be talking to my good friend Kyle Ford, learning how we can borrow money to make money. Before we do that, let's go to our stocks expert, Omar Khan. Omar?
Thanks, Rav. Omar Khan here, guys, with Theta Trading with a weekly market review. Pretty rough week last week in the stock markets. NASDAQ, which is the tech-heavy index in the United States, that was down 5%. S&P 500 down 2.5%. TSX down more than 2%. And why is this happening? Well, this is happening because something called the 10-year Treasury yield is increasing, which means this ugly word called inflation. When inflation comes in, there's a possibility of interest rates going up. So the market's been a bit spooked out by that, as well as some profit taking. So rough week last week. Second half of February tends to be a bit rough. So hopefully this corrects. We'll see how corporate earnings come up, but a little rough week. Let's hope for a bit more better performance going forward, okay? See you guys next week. Back to you, Rev. Take care.
Thanks, Omar. Talk to you next week. Kyle, thanks so much for being on the show with me.
Thanks again for having me, Rob.
Yeah, listen, you are a wealth of wisdom, and just even a few weeks ago, I was asking you about rates, and here we are in February 2021, and I was asking you about rates, and you were telling me that I should, if it was you would break the mortgage and, refinance and pull out money and not have a HELOC and just get a big mortgage and, all this kind of stuff. And I did exercise on a lot of that. But investing, there's so many aspects to it. But if we don't have the money, whether it comes from other people, whether it comes from our paycheck, whether it comes from what you're going to teach us today, our homes, then really you can't invest. And so, it's one hurdle to get people or to even get ourselves to invest in real estate, but then it's another to pull money out of our home to be able to do it. Talk a little bit about the mindset and kind of the, just in and around refinancing, Kyle.
Right. Well, just a little bit about myself, Rob. Going back, I have a financial planning background. I worked as a financial advisor for several years, and I saw so many Canadians working so hard to pay down their house, budgeting, really, really saving their pennies to make sure their mortgage payments were made and they could get that mortgage paid off. Then when it came to retirement time, their plan was to add a HELOC or refinance to pull that money out for retirement, or add a reverse mortgage, which is compound interest working against you. So if you can plan this in advance, if you're planning on having a mortgage for your retirement, why not have the conversation sooner and see if you can get those funds to work, earning a higher rate of return now, so you're not starting that compounding later.
Yeah, I mean, for number's sakes, you were talking about if somebody has a home and, let's say it's $800,000 and they've, have 60, 70, 80% of equity in there and they're so excited, I only have a couple more years and now my mortgage is paid off. You're like, in your opinion, obviously we want everyone to be able to sleep at night, but hey, why not refinance that, pull the money out as much as you can, and then take that money and put it to work? I guess that second part is where people, here we are, Kyle, in the third largest city of North America, if you don't count Mexico City, right? I think it's New York, LA, and then the GTA. And people, as much as, 4 or 5 million people, how many know that they can go put their money to work at 9, 10, 11%? A lot of people don't know that. A lot of people don't know the Kyle Fords that can help them do that. But give an example of that. So let's say I did refinance my home, got a new mortgage, then I go through somebody like a Kyle Ford and I can make 10% on my money. How does that happen? So I'm kind of going to step 2 before we talk about step 1, but get me excited about the fact of why I want to do step 1. How do I make that 10% in real estate?
In our brokerage, we do a lot of private lending, and everything we do is investor focused. So what we're looking for borrowers who are willing to pay a higher rate of return for more access to capital. They typically have deals that don't fall in that normal bank box. Maybe the condition of the property isn't great, or they're looking for a little bit more of an aggressive loan to value on the property. They're willing to pay a higher rate of return for that capital in the short term to get into the deal. So once the term we use is stabilize the property. So that's either through a value-added renovation or rental income. Once they've stabilized the property, this property would now fit in the bank box. So they get into the property with private capital, do their value-added renovation, stabilization, and now they're in a position where they can pay off the higher interest loan with cheaper money.
So basically what you're saying is you're giving Brother Rav a spanking, and you're saying, Rav, pull the money out of your property or properties, lend it to another investor. That investor needs $200,000 over a 12-year term. They're going to give me $20,000 on that 200. They're going to give me 10%, but they're making 70, 80, so they don't mind. That's what you're saying.
A 12-month term, just to correct you there.
What did I say?
12-year term.
No, 12, a 1-year term. A 1-year term that people need to borrow that.
Exactly. Their rate of return is substantially higher because of the value-added renovations they may be doing to the property. So they're happy to pay a 10% rate of return in that 1-year, 12-month span, so they can generate a higher profit themselves with more access to capital.
Okay, so Rav lends, Joe, $200K for 1 year. Joe is going to pay Rav 10%, which equals $20K. And if I want this monthly, I'm just guessing it's probably $16.60 a month. Per month. So what you're saying in a typical example is Rav lends Joe money. Joe needs the money for whatever reason. I'm taking a good look at Joe and looking at the whole portfolio, and I'm not just giving it on blind faith. We're actually looking that there's some collateral there, or he has other properties that I might put a lien against, or whatever the case is. He needs $200K for 1 year at 10%, $20,000, So therefore, I'm making my $1,700 a month. And what you taught me, or you reinforced, because sometimes we know this, but we need, like I say, we need someone to say, hey, if you can't sleep at night, don't do it. But if you can sleep at night, this is a great investment. Because what you said to me was, Joe's doing this because Joe might make on his investment in a year $80K. He doesn't mind paying Rav $60K. He nets $60,000. But the question is, where's Rav getting the $200,000? That's the question. All the Ravs out there, they like this deal. They want to do this deal, but where am I, Rav, getting the $200,000? And Kyle says, Rav, you're sitting on it. In most cases, we're sitting on that $200,000. So then I push back at you and I say, okay, if I refinance my house and pull out $200,000, I'm going to have to pay on that. So at today's rates, Kyle, just for fun, how much money am I paying in a year interest on that $200,000?
Right now, borrowing rates, let's use 1.8%. We can do a little bit better than that, but 1.8% is a relatively conservative interest rate. So I believe that's $3,600. Quick math. 200,000. $3,600 for the year. Exactly. Times 1.8%. $3,600.
$300 a month. So in order for me, this is what Rav's making, but I have to service the debt. So what you're kind of saying is that if it is $1,660 a month, I probably should get you to figure it out. What's 20 grand divided by 12?
$1,666.
$1,660.
$6 off. I think that's close.
Well, $1,660, and you're saying for me to pull that $200 out, it's going to cost me $300 a month, and so I'm netting $1,360 a month times 12 is
$16,320.
So $16K plus, and so that's what you're saying, Rav. Hey, would you like to go to a place like, I don't know, Turks and Caicos for a month? I think I get a villa for a month in Turks and Caicos for like 15K, Canadian, or maybe 3 weeks. And so, hey, Rav, every year you could go to Turks and Caicos for 3 weeks, some nice food and drinks, and it doesn't cost you anything as long as I could get my mind around the fact that I pull out $200,000 that I'm sitting on.
That's right, Rav. And it's all about your comfort level and being able to sleep at night. But this is a type of strategy that I'm finding so many Canadians are really finally being able to envision their retirement income by using this strategy. They know they have equity, they know they have money, but they don't know how to eat that equity in their retirement. They don't know how to go to Sobeys and get groceries with that equity in their retirement. But these type of strategies is really opening their eyes to say, wow, this income stream, not only is that my retirement later, but an extra $1,300 a month helps me now too.
That's right. And Kyle, where I think sometimes people go wrong, and I don't really mean it when I say go wrong, but where they can get in trouble is if, let's say they pull out the $200,000 and there's no Joe in the equation, and there's no lending in the equation, and I take this and I, reno my house. Now, there's nothing wrong with that if I'm going to increase the value and then I can pull more money out, but if I'm just renovating my house or, new car or whatever the case is, etc., that's where we can get in trouble. You're not teaching people, hey, pull the $200,000 out of your own house, Rav, and then, go to, Niagara Casino and put it on black. You're saying, take the $200,000 and borrow that money to make money. Yes?
Absolutely.
Kyle, love having you here. We're going to take a quick break, and then let's really go through the numbers of what it means to, I guess the terminology is refinance pull money out of our home. Let's go through what that looks like in Ontario anyways. I mean, is it the same rules across Canada, or does each province have its own in terms of what the guidelines are?
Generally speaking, across the country, a refinance is going to be the same. Some lender-specific rules in different provinces, potentially, but I think all in all, across Canada, we're going to be looking at generally the same rules.
Perfect. Don't go anywhere. We're talking to my good friend Kyle Ford. He's teaching us how we can make money borrowing money with the money that we are sitting on. Don't go anywhere. Everyday Investor continues in a moment.
At Theta Training, our goal is to help you achieve financial freedom by teaching you the foundations of trading stock options. Join our growing community. Learn through our live-streamed weekend course, or develop your skills at your own pace online. Understand how the stock market works and how you can use the options market to earn additional income. Achieve financial freedom and live life on your terms. Let us help you build your empire.
The mortgage world has changed. Has your advice? Are you looking for a modern approach to your mortgage planning process? Advice tailored to your unique, ever-changing circumstances? Whether you're upsizing, downsizing, purchasing, or refinancing, the Kyle Ford Mortgage team works with individuals and companies to custom tailor the right mortgage product for you. Working with a wide selection of lenders, we're here to serve our clients and help them achieve their real estate and retirement goals. Contact the Kyle Ford Mortgage team today, Canada's mortgage choice.
Hey, it's Rav. Welcome back to Everyday Investor. Today we're learning from my good friend Kyle Ford, the mortgage specialist extraordinaire. He's teaching us how we can make money by borrowing money and borrowing money from ourselves. Kyle, it's great to have you on the show. Thanks for nurturing me a few weeks ago, reminding me, kind of giving me a shake because I took your advice and I did exactly what you're teaching now. So for our viewers, let's give an example.
Awesome. So for the sake of this example, we're going to say we have $1 million home.
Okay, so our home is worth $1 million. Okay.
Right here in your town, Ontario, or your town, Canada. Current mortgage on that house is going to be $500,000.
Okay, so on my house, I have a $500K mortgage, and I'm not that smart, but that tells me that I also have $500K equity, in other words, cash in my house. Correct?
That's right.
Okay.
Now, in Canada, we can't access without using private money or more in-depth strategies, but with conventional banking, we can only refinance our property up to 80%. So we have $300,000 in available equity.
So what you're saying is we've got to leave in 20%. So again, our mortgage right now is $500,000. The bank says I got to leave in there 20%, which is 200 grand. So the difference here is that's where you get the 300K. I can have at my disposal, if I want, $300,000 because my mortgage is already 5 and I've got to leave in 200. Yes?
That's correct.
Okay. You probably teach it in a more cleaner way, but are we at the same place?
Yes, we are.
Okay, so I can take out $300,000.
Yeah, and I just want to stop here because this is a question that people always ask me. So if I can take out, if I have a $500,000 mortgage and you're suggesting I take an $800,000 mortgage, where does the $300,000 go? Where does it come from? And this is because every person who's ever gotten a mortgage, they sign on the dotted line and they make payments. When you're refinancing the house, the bank is advancing the cash or the equity that you already own back to you. So on closing, when you get this new $800,000 mortgage, when you go to your lawyer, you're going to have a bank draft certified for $300,000 in cash available for you to invest.
And it only takes a few days.
That's right.
Okay, so my mortgage is $500,000. I'm sitting on the other $500,000. The bank wants me to leave in 20%, so $200,000. So the difference between that is $300K. So I can take out that $300,000. Okay, so how, in what form, because now I have an $800,000 mortgage. But I also have $300K in pocket. So now what do I do?
So if you were to refinance today at $800,000 at the 1.8% interest rate that we reference and did a new 30-year amortization, your monthly payment would be $2874.95.
So that's how much I would pay monthly.
Correct.
Okay.
The $300,000, if it were invested at 10%, would pay monthly $2,500.
$2,500. Okay, so can we go annual for a second? So what's 2875 times 12?
34,500.
34,500, and this I can make 10%. So then therefore I'm making 30,000. So I am paying 4,500, and the big number here is the year. So over the year, I'm paying less than $400 a month for this entire operation.
That's correct.
I'm paying $4,500 per year, but I'm making $30,000. So basically what you're saying is I'm making $25K profit.
Correct.
$25K profit. Basically, right? Actually a little bit even more, but I'm making $25,000 profit. So, Kyle, why? Okay, well, here's a question I have for you. This 10% that still seems too good to be true to lend my $300,000 at. We already talked about what types of people, but is there a demand for this? Are people looking to borrow money for whatever reasons? Today in February 2021 during COVID?
Absolutely, they are, and I think a lot of people who have been to their bank recently will understand that banks are tightening up. They're not as aggressive to lend at these 1.8% interest rates, which means for a homeowner, it's not as difficult for them to get one mortgage. But if you're an investor who has multiple properties, the banks aren't necessarily lining up to give you a ton of money. These types of borrowers who are sophisticated, professional, educated in their space are looking for capital to help fuel their business. So 100% absolutely on a daily basis, we have files and opportunities funding at 10% or greater in terms of interest rate.
And are these usually 1-year terms?
They range, I generally tell people between 6 and 18 months.
6 to 18, but I'll know which one it is. I'm not putting my money in a fund. This is a specific person who needs to borrow this money. And so I'll know ahead of time whether it's 12 months, 18 months, pretty short term.
100%. I always say it's the golden rule. He or she who has the gold makes the rules. So when it comes to lending your money, you pick the term and the borrowing opportunity that fits best for you.
And obviously there's a few bucks, not a lot, but there's a few bucks associated, meaning maybe an appraisal of the borrower's property that they wanted to do work on, or a lawyer gets involved. So there might be, a few $100 here and there. Is it Rav who's lending the money that pays that, or is it the borrower that takes care of those fees?
These are true net returns. In any lending opportunity that comes your way, all of the fees are paid for by the borrower. So the cost associated for me to broker the transaction is paid for by the borrower. The legal cost to have your loan registered on the property is paid for by the borrower. The appraisal cost is paid for by the borrower. I tell my lenders all the time, the only thing that you got to pay for is the fuel to drive to your lawyers to sign and your cup of coffee along the way. Other than that, all the other expenses are covered.
And with DocuSign, you don't even have to do that anymore.
That's right. That's right.
Okay, so Kyle, on this 1.8, this was the number right here. When they had a $500,000 mortgage and, you know, they got a rate at, let's say, 3%, what were they paying on that? So they have an $800,000 mortgage, 1.8%, they're paying $2,875. What were they paying on a $500,000 mortgage at 3% monthly?
So in this example, I put the amortize at 3% monthly and the amortization at 20 years, because most people who have their mortgage paid after a number of years, their amortization is less. I put their payment at $2,480.75. So $2,480 is the monthly payment. And the question I get all the time from people is, well, I just added 10 years to my mortgage. I totally understand and appreciate that. And if paying off your mortgage is your number one goal, you may consider doing a HELOC versus the refinancing strategy. But what I ask my lenders all the time, no matter how old you are, if you have the ability to borrow your money at 1.8% and lend at 10, do you care if you have a mortgage in your retirement? And most of them stop and think and say, no, I don't. I just don't want to be paying for it anymore. The reason why I recommend this strategy for so many investors is by re-amortizing the mortgage, creating the lowest monthly payment possible. It creates the greatest amount of cash flow for my lenders. And then they can, if they so choose, they can take the cash flow and accelerate the mortgage back down if they wanted to, or use the income to fund their lifestyle.
Mama always taught me that money today is better than money tomorrow, right? Obviously. And you know, it's always funny when people tell me they got a huge tax return. I'm saying you're probably not doing it right if you got a huge tax return. You want to owe them, because it means you get to keep more of your income today than tomorrow. So Kyle, you know, this is very interesting. I mean, the mortgage at $500,000 at a 3% rate is $2,500. When I pull out $300,000, it's again like $400 more. I'm only paying $4,000 or $5,000 a year difference, but now that $300,000 is going to work for me. You know, again, some people don't know this, hence this show. A lot of people know this, like myself, but we just kind of forget. Like, you know, obviously I'm paying down my mortgage and I've got my other investments, and all of a sudden I blink and I have in your mind, or what you told me, I have too much equity in my house. You know, I had another friend tell me that it's criminal to have too much equity in your house. Now, that being said, everybody's different. If you sleep better at night by having your mortgage paid down, then that's great too. There's not one shoe that fits all, but if you're looking to grow your money, this is one of the ways to do it.
And what I tell my clients all the time is the medium between this suggestion is a home equity line of credit. You can leave your mortgage alone and just add a home equity line of credit and access it like that. The challenge with that is your overall debt service will be higher because the amortization on the mortgage is lower and the HELOC interest rate is higher. I don't want to get too technical here. But if you're looking to embrace this strategy and really say, like, you know, I'm going to be a lender and I know I can consistently get 10%, I'm comfortable mortgaging. My suggestion to most clients, assuming they sleep at night, is to mortgage versus HELOC.
Yeah. Kyle, time's up, my friend. Thank you so much for being on the show with me.
Happy to be here, Rob. Thanks again.
Yes, we'll see you again soon. And I really appreciate your weekly tips as well. And I really appreciate you at home watching the show. Without you, we would not have one. Make sure you tune in next week, same place, same time. Honey, I love you. I'll be home soon. Thanks for watching, everyone.